Have y'all heard what's going on? This is the second largest bank failure since the Great Depression.
The FDIC just reported that California regulators shut down Silicon Valley Bank, a big lender out in California, after reporting a loss of over $1 billion. There were fears of a run on this bank.
This really is an earthquake, especially for the tech community. Silicon Valley Bank dropped by 60% yesterday alone. We just learned today that California regulators have shut this lender down. It's actually the second biggest failure ever since Washington Mutual in September of 2008. This is a major lender to tech startups. The FDIC says that insured depositors, they will have full access to insured deposits by Monday morning. Insured deposits, that means up to $250,000.
And 97% of SVB accounts had more than the insured limit, according to S&P Global Market Intelligence.
Whether or not you have in your account a larger amount than that depends on what happens over the weekend. If the company sells itself and sells its assets for equal or greater than the asset value, there's a better chance you're going to get more than $250K back. If it doesn't, there is a chance that you could have a loss.
San Jose-based Roku held nearly $500 million at SVB, and the company doesn't know if it will recover the funds.
SVB is also the main bank for California wineries, according to the San Francisco Chronicle. So that means there are thousands of wineries who don't know when they'll have access to their money, just like all of these other companies and individuals. As you could probably guess, a lot of them exceed the $250,000 deposit insurance by the FDIC, which means it is a waiting game for them to get their money.
People are saying that Donald Trump predicted that this would happen.
All of this incredible job that we've done will go down like that. It will be a terrible, terrible sight. It might even be a 1929 situation, so you have a chance to have the greatest numbers in history. You're almost there. We're almost back to where we were from the standpoint of the stock market. Think of that. But you'll have a crash like you've never seen before. You put the wrong person in office, you'll see things that you would not have believed are possible.
Warren Buffett predicted what will happen next.
It's really like the old movies, you know, where there's a run on the bank.
It's getting so a guy's money ain't safe unless it's in his sock.
If you have a run on a bank and there's a big line in front of the bank and you've got your money in that bank, you're going to get in line. And if the president of the bank comes out and says, our capital ratio is 13%, you don't care because, you know, you don't know what a capital ratio is and you don't know whether he knows what one is and you know he's probably lying to you. A company like Lehman or any major financial institution depends on people being willing to do business with them tomorrow and lend them money tomorrow and take their word the next day. And nobody has to do business with Lehman or any other institution. Once they lose confidence, it's all over.
Many founders, investors that I've talked to have been desperately trying to get their money out. Some were successful and some were not. In fact, I think we have video of the scene right now at one of the SVB offices in New York. You can see that a few founders had collected and they were trying to get their money out. They were turned away. Other founders that I've talked to tried to go to actual bank branches and get cashier's checks so that they could walk to another bank and deposit those. A lot of fallout is still being figured out right now in the Bay Area. A lot of the people I'm talking to are trying to figure out what is next. I talked to one founder, Scott, who says that he was just about to wire money to his new SVB account. He's thankful that he didn't, but now he doesn't know what's going to happen because it takes time to open another business account. And the startup environment, by the way, is getting all the more tenuous because of this failure.
Why exactly is this happening? Well, let's listen to an expert, the host of Wall Street Grit. She explains this very well.
Silicon Valley Bank is in big trouble. They are the 15th largest bank in the United States in terms of assets. They sold off $21 billion in bond portfolio for a huge loss to shore up their balance sheet. The market is really worried. The stock is down 54% today. Here's what you need to know. They announced they completed a $21 billion fire sale, never a good sign, of part of the bond portfolio. And they took a $1.8 billion hit on that sale, which is equivalent to more than they generated in net income in 2021. So terrible loss. Now they've announced that they're going to sell $2.3 billion in shares to cover the bond loss, and then the stock crashed because they're scrambling now to shore up liquidity. Selling shares to cover up losses is a huge red flag, and it's been a terrible week for banking because just yesterday, Silvergate Bank, the crypto bank, said they were winding down operations due to many of the same issues that Silicon Valley Bank is facing, which we'll get to in a second. But how is Silicon Valley Bank's liquidity position doing? So according to the company, they have $180 billion in available liquidity to cover the $169 billion in deposits, so not too bad. But dilution is a big problem because, and this is why the stock is tanking, they want to issue $2.3 billion in new shares. That would be about equivalent to a third of the company today's market cap. So huge dilution. And the stock was already down 47% year over year before today's sell-off. So why are they selling off bonds at such a huge loss? The bank is facing two huge problems. The first is interest rates. They were positioned horribly just before interest rates increased. The company's $21 billion bond portfolio had a yield of 1.79 and a duration of 3.6 years. Compare that to today's 3-year treasury yield of 4.71%. So as interest rates rose over last year, the value of that bond portfolio fell dramatically, and the bank had a choice: ride out that 3-year duration of its bonds with a yield far below the current treasury rate, or sell at a loss and reposition the portfolio to maximize yield. Basically, Silicon Valley Bank had to decide how quickly it thought rates would decrease, and clearly they don't think rates are coming down anytime soon. The other problem with this bank is deposits. See, it's highly popular for tech companies, and because the tech market is not doing well, that means fewer deposits for this bank. And the restricted IPO and capital markets mean that VC-backed tech companies have less money to deposit in the bank. Moody's cut the company's credit rating and downgraded the credit outlook to negative, and the stock, I don't know. I don't think it's going to do too well here. I think it's in for a very bumpy ride, maybe just as bad as Silvergate Bank, who had to cease operations. Make sure to hit that follow button for more insights like this.
If you like this form of content, go ahead and like, share, and subscribe to my channel because I'll be producing more in the future. The scary part is that when the pandemic started, the Federal Reserve suspended reserve requirement. Normally, a bank was required to hold at least 10% of all deposits on hand at the bank or in a vault at the Fed. The reserve requirements are still suspended, which means that the bank may not actually have any of your money on hand.
You do not really understand the concept of banking. All the banks are broke. Bank Santander, Deutsche Bank, Royal Bank of Scotland, they're all broke. And why are they broke? It isn't an act of God. It isn't some sort of tsunami. They're broke because we have a system called fractional reserve banking, which means that banks can lend money that they don't actually have. It's a criminal scandal, and it's been going on for too long. To add to that problem, you have moral hazard, a very significant moral hazard from the political sphere. And most of the problem starts in politics and central banks, which are part of the same political system. We have counterfeiting, sometimes called quantitative easing, but counterfeiting by any other name. The artificial printing of money, which if any ordinary person did, they'd go to prison for a very long time. And yet governments and central banks do it all the time. Central banks repress the amount of interest that rates are, so we don't have the real cost of money. The sheer effrontery of this is quite astonishing. It's central banks that manipulate interest rates, Commissioner. And plus, underneath all this, we talk loosely, in a rather cavalier fashion, do we not, about deposit guarantees. So when banks go broke through their own incompetence and chicanery, the taxpayer picks up the tab. It's theft from the taxpayer. And until we start sending bankers, and I include central bankers and politicians, to prison for this outrage, it will continue.
We are in unprecedented times. So it is a good idea to stay up to date so that you are aware of what is going on. Educate yourself so that you can protect yourself. Understand that this will create a lot of opportunities. You just have to be patient. This information is for educational purposes only. This is not financial advice, but it doesn't sound like it's the best idea to have all of your money in the bank right now. It wouldn't hurt you if you had some cash on hand, some physical precious metals, or even some cryptocurrencies. I'm going to go ahead and drop my Coinbase link in the description below. So if you don't have a Coinbase account, you can actually get started with crypto. Once again, I'd like to thank you for watching this video. Until next time.